Hello and welcome to Views from the Market, mid-market private equity and M&A in Canada. My name is Mario Nigro and I'm a partner in the private equity and M&A group at Stikeman, Elliott. For today's podcast, I'd like to welcome our special guest, George Sabbouh. George is the head of the Canadian Financial Sponsors Practice in the Investing Banking Group at Stifel. George, thank you for joining us and welcome.
Mario, great for having me.
George, we always start our podcast by asking our guests a little bit about themselves, and obviously love to learn more about you and more about your work at Stifel.
Yeah, happy to kick that one off. Again, my name is George Sabbouh. I actually sit in the Toronto office working for Stifel Financial, which is a global investment bank. We're predominantly middle market and investment bank, probably the fastest growing firm on Wall Street. We're around a 13 billion market cap company, 9,000 associates, over 400 locations. We also have a large wealth channel, over 600 billion in AUM. We're a full service investment bank ranging from investment banking siloed specific groups to leverage finance, to wealth, as we mentioned, to restructuring, and myself, where I sit in our financial sponsors group that consists of over 15 individuals who only cover private equity firms. We cover over 1,000 global private equity firms, so know the market well. So we're a global bank, and we do it all.
George, I'm going to take advantage of that kind of depth and breadth of Stifel. I mean, what I know about Stifel is like they are a market leader on so many kind of verticals, industry sectors, but also just both public, both private. So I'm going to take advantage of what you're seeing in the market, if I could, and just kind of talk a little bit about just what you're seeing in this market. It's a bit of a wild market in many ways, a crazy market with all these various factors. But I mean, in our world, we always want to start by asking if you're busy, because that's great for us. What are you seeing? What are you working on? What kind of deals are you working on? Because that's obviously an indicator for the marketplace about what's coming down the pipeline.
We're actually quite busy, to be honest with you. It's a lot of M&A. As you know, metals and mining is going through a ceiling right now, which is awesome to see. Our metals and mining group is probably starting up a deal every week at this point, which is great. But if you look back, call it 2025, it was a weird year, as in it was just more K-shaped as a recovery. So call it deal headlines and exit values. They were up big. They were driven by mega deals. A lot of take privates were being done in 25, 24 landscape. There was actually 65 done since 2021, which is on averaging over 12 a year. Traditionally, you'll see 2 to 3 a year. So kind of we saw the opposite. You can kind of see the broader market was also kind of constrained by a liquidity crunch, meaning a lot of LPs wanted to essentially money back. However, from the GP standpoint, there was still a bid-ask spread between sellers and buyers, hence why now we're seeing longer hold periods. Like you saw on average now, hold periods go from 3 to 5 years. Now they're hovering around 7. So again, it's kind of 25 was a soft year. Q1 did well. Q2, tariffs came. That just muted everyone, put everyone on pause. Q3 popped. We saw a lot of activity happen in Q4, but now Q1, year over year volume is down. It is quieter this quarter. However, we expect 2026 to pick up by a lot.
You work a lot with private equity funds. You see them in our marketplace as both buyers and sellers. Well, obviously this tariff impact has kind of been affecting the whole market. Have you seen them less active? Are you seeing them more focused on certain industries, George? Are you seeing specific type of buyers these days with all that's going on in the world, or certain type of assets that are really getting more attention than others?
The obvious groups clearly are the business services, infra services, waste. Those three just have outperformed a lot of the other subsectors. Predominantly, again, they have less end market tariff exposure. So if you have an asset in that sector, it's trading, and they're trading, a lot of them, depending on quality and size, near 2021 levels. We're seeing a lot of interest too from US sponsors come up into Canada. Again, I think I mentioned on your panel, there's actually over 500 portfolio companies owned by US sponsors, and it's quite active. Like on every one of our processes, we include our US sponsors team, which allows them to plug in their US sponsors. And we're seeing a lot of the bids, the higher bids, come from there. So it's very active, great sectors to be in. Manufacturing and then clearly retail consumer has been a little quieter, clearly, but that's kind of rebounded from last year and the year before that. And then building products at the same time too is also kind of normalizing out from the 2021 surge levels. So again, if you have an asset in that space, a lot of people are kicking off processes. There's also less deals in market now. So when people go out, it's just more eyeballs on deals. Does it necessarily mean they're more transactable? Not necessarily, but a lot more eyes for sure.
George, I want to get your thoughts because you see more of this. It's a strange market, right? Where the really good assets are getting really high valuations, but then the assets in the spaces we talked about, the manufacturing and consumer products, some of the B2C stuff, it's harder to get the kind of valuations that we saw years ago. What are you seeing on valuations? Are you seeing any particular trends, anything that you notice out there when it comes to pricing these companies for sale?
Yeah, from a business services, infra services, again, waste, they're trading well. They're trading, again, 2021 levels. Again, it depends on size and quality and end markets. Consumer manufacturing, they're coming back, but they're definitely not in the 21 levels for sure. And again, it really depends on end markets and how much tariff exposure do you actually have. Commodity exposure as well, too. So there's a lot of factors and nuances that go into it. But there's a reason why, again, if you looked at the Canadian public markets, there's a reason why there were so many take privates done in the past 5 years. There was just a big ass spread from an arb point of view. And if you think about it, the majority of buyers of those financial take privates, of the 57 completed, 31 were US financial sponsors.
You are seeing more, obviously, greater interest in private equity in our marketplace. And I know your feet are on the ground when it comes to PE firms doing deals. You mentioned some of the sectors that they're looking at. What I would say is, newer in the fold, any newer industries, any peculiar industries or any trends you see when you look at these type of buyers and what they're looking for. I'm not asking you for the secret sauce, so you don't have to disclose, George, but anything that you notice that is evolving, changing. Sometimes we're seeing a lot more AI play a factor or role, and anything you're seeing in these buyers when they're looking at deals in our marketplace.
Yeah, I think the most obvious one in today's market is AI disruption. Clearly, you can see tech has gotten hit pretty hard. And again, I think there's a lot of pivot back to blue collar, business services, infra services spaces, right? That's by far the most popular. And I think for most IC committees at sponsors, they got to really evaluate if there's genuine AI risk. I know it is clearly a buzzword, but it's real. And that's probably one of the hindering factors for deals to being completed if it does, one, have that risk. Two, it's just longevity. It's like, how do I get out of it in 5-7 years, right? Is there end market exposure on my exit value? And if there is, they're clearly underwriting a lower multiple coming in. So I think in today's market, again, you got to assume multiples are flat on an exit, which most sponsors do anyway, but it's heavy now growing EBITDA growth year over year to get that same MOIC that existed in the late 2000s. Interest rates were just higher back then. It was just cheap cost of capital back then. That influences multiples are up. So how do you combat that? Clearly with EBITDA growth. And I think to get back to that same MOIC, it's just the math has fundamentally changed a bit, just pivoted in different buckets.
George, when you look at this marketplace and, there's a bit of uncertainty at 26 with the tariffs and where they're going to land, and, hopefully we get something resolved with the U.S. on Kuzma. What do you see coming up? Any particular trends you see? And you have a great visibility because you see a lot of the U.S. and what's happening amongst the U.S. buyers. Any trends that you see coming our way or we should keep an eye out for, or things that you would say are noticeable out there in terms of what's to come?
Yeah, I think 2026 is going to be a great year. With easing interest rates, IPO rebound is big. It's happening. There's just a lot of corporate M&A appetite out there. Again, with the economy coming back, again, there needs to be assets put into market. There's a lot of dry powder out there. I think globally right now, they're sitting on accumulation of 1.3 trillion, and that's almost a near record level. And that's a lot of capital coming from the 2022, 2023 vintage era, meaning that needs to be deployed sooner rather than later. I think what we're also seeing too is there's a lot of aging portfolios. So there's around, again, globally, there's north of 32,000 unsold companies. And eventually they have to come to market. Sure, are the average record hold times higher now? yeah, they're now hovering around that 7-year mark, but it's still, sponsors are waiting for markets to rebound before launching. Because what you don't want to do clearly is launch it in a bad market or when EBITDA is down. We're seeing a lot of pivoting though to some other products, continuation vehicles being one of them. They were actually 10% of exit value in 2025. So let's call it right now an $80 billion market. We're seeing a lot of dividend recaps, and we're actually generally seeing IPO exits. We were actually just on one. We took a company to market, soft circled it with some early strategics and sponsors. We got low bids, and we actually ended up IPOing it at an extra 40% of the value. It's trading higher now. So there's just other options for sponsors nowadays to at least give LPs some cash back to allow them to eventually put that money back to work when they go raise new funds.
George, I want to thank you for joining us. I think it's great to hear your perspective on what you're seeing at Stifel, given its global footprint and just the window that you have into the type of buyers in our marketplace. So thank you for joining us. Thank you for telling us a little bit about what you're working on and what you're seeing. We greatly appreciate it.
No, I appreciate you having me. Thanks, Tim.
Thank you for tuning in to Views from the Market. Stay updated with the latest episodes by subscribing wherever you find your podcasts or visiting stikeman.com/viewsfromthemarket.